growth slowdown. The unemployment rate is going to rise. People are going to be working less. This is not a favorable economic environment. And whether we're growing 0.1 or negative 0.1 will definitely...
A country's economic growth is measured as an increase in people's real income. That is, the ratio between people's income and the prices of what they can buy is increasing. Goods and services become more affordable and people become less poor. In this video, we will talk about the current rate of economic growth in the United States and its consequences. Economic growth is an increase in the quantity and quality of economic goods and services produced by a society. The total income of a society corresponds to the total sum of goods and services produced by the society. Everyone's spending is someone else's income. This means that average income corresponds to average production, and that average income in a society rises as goods and service production rise. Slow world economy growth and rising unemployment in the industrialized world, combined with the end of the Cold War, which once united the capitalist countries of North America, Europe, and Asia, have given new life to nationalism, regionalism, and protectionism in various parts of the world. The term sluggish economy is a colloquial phrase used frequently in financial and business media with no exact quantitative definition. It is a zoological analogy to slugs, which move very slowly, in some cases moving at an average speed of only 0.000023 meters per second. Like a slug, a sluggish economy is moving ahead but very slowly. Though the term sluggish economy can refer to slow or no economic growth, it is rarely used to refer to negative or outright contraction in an economy because slugs are physically incapable of moving backward. In a sluggish global economy, many countries can still experience positive growth, but the overall pace remains slow. Both during and after the Great Recession, a sluggish American economy had a negative effect on the global economy. This is because the United States had the largest economy in the world and was a vital source of trade and investment for much of the rest of the world. During periods of slow economic growth, the Federal Reserve may lower interest rates in an attempt to stimulate the economy. This increases the circulation of money in the economy, thereby stimulating more economic activity. When the economy begins to overheat, the Fed may take the opposite action, reducing the amount of money in circulation. What are the effects of a sluggish economy? A sluggish economy, despite the lack of a formal definition, is frequently characterized by declining consumption, low GDP growth, or rising unemployment. People may decrease their consumption and increase their savings as a result of a greater sense of economic precarity. Due to the self-fulfilling nature of reduced consumption, the economy as a whole suffers. What causes a weak economy? There are many potential reasons for a weakened economy, from domestic political factors to worldwide market conditions. Regardless of the proximate causes, high levels of unemployment, debt, or inflation can cause economic weakness by reducing consumers' discretionary spending. The recession in the United States officially ended 2 years ago, but in much of the country, housing prices are still falling, jobs are scarce, and growth remains weak. A low growth rate is much more than just a number. According to economists, slow growth can have an insidious effect on a country's prospects and options in ways that not everyone understands. This was supposed to be the year when the US economy finally took off. Instead, it appears to be stuck in the mud, according to former Federal Reserve member Alan Blinder. The economy has been consistently disappointing on the low side for several months now, which makes me and other people concerned that this slow growth may last longer than we now believe. The United States economy is growing at a faster rate than many economists predicted. From April to June of this year, the country's GDP increased by 2.4%. A number of economists predicted that the figure would be 2%. U.S. inflation is at a 4-decade high following supply chain disruptions, a tight labor market, and fiscal and monetary stimulus during the COVID-19 pandemic. Despite a slight easing since June, consumer price inflation remained high at 8.3% year-over-year in August. The Federal Reserve is now determined to bring inflation back to its 2% target and will likely raise the federal funds rate to 4% or higher by the end of 2022. The U.S. economy is still expected to avert a recession as tight labor markets support sustained growth in consumer spending. However, rising financing costs will lead to significant declines in residential and commercial construction. We expect real GDP growth to slow from 5.7% in 2021 to 1.7% in 2022 and 0.9% in 2023. before edging up to 1.3% in 2024. With growth falling short of potential, the U.S. unemployment rate will likely rise from 3.7% in July to 4.7% in 2025. A hypothetical scenario of economic collapse and its potentially disastrous consequences. The stock market is frequently regarded as a barometer of the economy's overall health. When it performs well, people continue to invest. However, even a minor lack of investor confidence can trigger a rapid downward spiral. People may begin selling their stocks in response to major events such as the bankruptcy of a key player or negative economic news. Political tensions, like the pending vote to raise the United States debt ceiling, exacerbate the situation. When a few start selling, a snowball effect occurs, leading to panic. Within hours, billions of dollars are lost in the U.S. economy. Companies' stock values fall, including major players like Jeff Bezos and Elon Musk, whose net worth is heavily reliant on stocks. Billionaires and small investors alike suffer, with retirement savings vanishing. Entire businesses are in danger of going bankrupt, resulting in job losses and an uncertain future. Day 2 arrives with the U.S. government in panic mode. This is the worst stock market day since 1929, surpassing even the devastation of the Great Recession of 2008. A bailout bill is proposed to prevent further economic collapse, similar to actions taken in 2008 and 2020. However, the bill is rejected due to political divisions, further undermining economic confidence. The crisis worsens by day 3. The stock market remains closed. Grocery stores experience panic buying and looting begins. People's actions become the norm during times of panic, resulting in fights over basic supplies. This behavior worsens shortages, leading to even more panic. Day 4 sees an increase in bank withdrawals as people seek more reliable assets than cash. Banks face shortages of cash on hand and enforce withdrawal limits. The U.S. government starts printing money to address pressing issues causing inflation concerns. Meanwhile, tensions rise as the deadline to raise the debt ceiling approaches. The United States faces default on day 5 because Congress fails to raise the debt ceiling. Other countries began seizing American assets, further deteriorating the economy. Public dissatisfaction grows, resulting in riots and social unrest. The president's ability to lead is questioned, and the world watches. By day 6, international tensions rise and U.S. allies begin to distrust the country. Calls for extreme measures emerge, including seizing billionaire assets. The public's trust in the government is eroding, sparking protests and violence. The president's actions are scrutinized and unrest spreads globally. Day 7 brings viral footage of American unrest as protests turn violent and assets are seized worldwide. The president addresses the nation but fails to restore confidence. Riots intensify and National Guard members refuse orders due to personal connections and economic concerns. Day 8 sees a collapse of American influence globally. Allies cancel deals, businesses shutter, and assets are seized. A sense of desperation grows, leading to calls for extreme measures to salvage the situation. By day 9, it seems inevitable that America's economy will collapse. The president's address offers little reassurance, and the U.S. dollar's value plummets. The country's reputation diminishes, causing a ripple effect globally. On day 10, the situation worsens, with the president struggling to restore order. People are preparing for a prolonged economic collapse as a result of public panic. In preparation for the worst, the prepper community keeps supplies in reserve. The possibility of economic recovery depends on government actions. Lessons from other nations' experiences with collapse underscore the importance of unity and savvy policymaking. Yet the political landscape remains tumultuous. Understanding the potential effects of an economic collapse in a hypothetical situation like this highlights the significance of responsible governance and group action. If you thought this video was very informative, please leave your feedback in the comment section. And don't forget to share, subscribe, and click the bell icon for more videos.